Definitely, you've been in a situation like this where the price broke a resistance level and you thought that's it, the price is going to continue advancing, but shortly after the price turned back below the resistance level, hitting your stop loss and leaving you wondering what happened. The answer is you were caught in a bull trap. In this video, I'm going to show you what a bull trap is and how you can avoid it. Stay with me. A bull trap is a situation where the price breaks a resistance level and we have a temporary rallying of the price, and market participants consider this as a starting point of a bull run and see this as a good opportunity to enter a trade. But shortly after, the upside move loses its momentum and starts falling back down the resistance level. All those bullish traders who entered a trade on the breakout of the resistance level are now trapped when the price starts falling back down the resistance level and hitting their stop losses. Bull traps are usually created by institutional and large traders who have large amount of capital, and with their large amount of money and high level of leverages, they just push the market out of the resistance level, giving the impression to retail traders that the price broke the resistance level and it's gonna further advance. So retail traders enter the market and buy the asset in the hope that this is a valid breakout. But shortly after, when the price advanced a little bit more, those institutional and large traders close their long positions, which means placing short position of the same size to exit the market. And this large short position suddenly create a heavy downside momentum and causes the price to turn back below the resistance level. So this is how a bull trap happens. And now you may wonder if there is any way to avoid bull traps. I'm going to share 3 tips that help you to avoid bull traps to some degrees. Just make sure you watch this video until the end so you won't miss any important points. Number 1, trading only in the direction of the main trend. When a breakout happens, it's better to identify the main trend of the market from higher time frames or through price action analysis or some indicators and enter a trade only if the breakout is in the direction of the main trend. Why we do this? Because for those institutional and large traders who enter at the point of the breakout in this situation, there is higher probability that they run on the main trend. When the breakout is in the direction of the main trend, they are more likely to stay in their positions for longer time to catch higher profit as the main trend is continuing its direction. So one way to avoid bull traps is to only enter on the breakouts that are in the direction of the main trend. Please pay attention that this is not necessarily true always, and we can have the opposite. All we are dealing with here are probabilities, and the probability of having a bull trap when the breakout is in the direction of the main trend is lower, and all we are trying to do is to lower the risk of getting caught in a bull trap. Number 2, trading the pullback. One of the ways to avoid getting caught in bull traps is trading the pullbacks, which is an ideal method especially for conservative traders who want to lower the risk as much as possible. Many of the times when the price breaks a resistance level, we have a pullback to the broken level, and after testing of this level, if the breakout was real, the price advances and continues in the direction of the breakout, and if the breakout was not real, the price goes back below the resistance level. As I said, this is a whole conservative approach. The pullback and retest of the broken level may not happen and the price may just continue advancing, and in this case the trader has lost the opportunity. The more you lower your risk, the more opportunities you lose, and this is a balance that you need to make based on the degree of risk you're willing to take. Here, based on this method, a trader waits for a pullback and then enter a trade when the price starts advancing. To even more making sure that the price is going to advance, the trader may wait until this resistance level is broken. Pullback trading is a great method of avoiding bull traps, and it provides a very low risk trade. And the third point for avoiding bull traps is when the breaking candle is considerably long and the price kind of shoots up above the resistance level, and in this situation it's very probable that it's a bull trap, and it's a good idea to watch the next 1 or 2 candles to see if they show any sign of decreasing bullish momentum. In this situation, candlestick patterns can help you a lot. For example, having a bearish candle or pattern in this situation indicates that the advancing paused and declining of the price is probably going to happen. A desired situation here is that the price forms a pullback and then advances, which can provide a good opportunity to enter a trade. By the help of the tips and methods I explained, you can avoid bull traps to some degrees. Actually, you will have higher probability of not getting caught in a bull trap. Bull traps are usually created by institutional and large traders, and knowing exactly when they're going to enter or exit is not easy, but by following the methods I explained, you can be at least sure that there is lower probability probability for you to get caught in a bull trap. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video and good luck with your trading.